Hello. How may I assist you today? Dalbar's Quantitative Analysis of Investor Behavior Report is an annual study that has consistently found a significant gap between the average returns earned by individual investors and the broader market. According to their research, the average investor tends to underperform the market by a significant margin over long periods of time. Over the past 20 years, the investors in the Dalbar study earned a net return that was 2% per year lower than if they never made a single change to their account over those 20 years. Investor behavior often results in poor investment returns relative to a blind squirrel throwing darts and randomly picking investments for several reasons. 1. Market timing. Short-term market swings and media news events lead many investors to frequently buy high and sell low. 2. Overconfidence. Investors may believe they have more knowledge or skill than they actually do and may make investment decisions based on intuition or feelings, rather than objective data. 3. Herd mentality. Investors may be influenced by the behavior of other investors or the media. 4. Emotional biases. Emotions such as fear, greed, or regret may lead to impulsive or irrational investment decisions. The combination of these factors can lead to poor investment returns compared to a properly diversified investment approach, which does not rely on market timing or emotional biases.
Is the talk of the business world. It's being discussed on the earnings calls of a wide range of global companies, from global tech giants to energy firms to Wall Street giants, and for good reason. It was launched on November 30th of last year, and the chat brought in over 1 million users in its first 5 days. Now fast forward 2 months later to January 30th of this year, and ChatGPT has amassed over 100 million users, making it the fastest growing consumer application in history. Now, to put this into perspective, it took TikTok about 9 months to reach that mark, and it took Instagram about 2.5 years to hit that. So ChatGPT is certainly the talk of the town, as they say, but is there more to it than just media hype? Now, the artificial intelligence bulls would say that it's Silicon Valley's next big thing. They're saying that it's like perhaps the next industrial revolution that will absolutely change the way in which we all work. Now, on the other side of the equation, we have the bears, the skeptics, who are of the view that it is overtalked, it's overhyped, and maybe rightly so, they're reminding us that it was just a couple of years ago that the media was hyping up virtual reality and that all of us would be working together in the metaverse. They're saying this is just another technology fad that will fade away once the novelty of it all has worn off. If we all go down that internet rabbit hole even further, there are some that are saying we're witnessing the dawning age of true AI and maybe sparking fears in some of us that Skynet will descend and drop down on us and take over the world, kind of like in The Terminator or The Matrix or other futuristic movies of our collective youth. You see, with the media, because their goal is our eyeballs, because they are looking to get ad revenue through clicks, maybe as a goal over and above delivering us knowledge and intelligence, it becomes very difficult for us to figure out whether something is just hype or whether it's truly investable. Now, our goal this evening is to see if we can cut through that media hype, because there has been many recent examples, as I'm sure all of us know. It wasn't too long ago that Marijuana was hyped and Bitcoin, and we all know how that ended last year for investors. Our goal this year is to cut through that hype and to see if we can take a look at what does the economy have in store for the year ahead and what does the investing landscape look like in front of us. Good evening, everybody. My name is David Sung. I'm the president of Nicola Wealth, and on behalf of our entire team, it gives me great pleasure to welcome all of you to Finding Alpha, Nicola Wealth's 2023 Strategic Outlook. Presenting alongside myself and John Nicola this evening, it's going to be a little bit like speed dating. We have Mark Hanna, our managing director of our real estate division. We have Bijal Patel, our CFO and head of our private capital group. And we also have Ben Jang, our portfolio manager within our public assets team. And collectively, they'll each be sharing their perspectives on their different asset class verticals and what they see in the year ahead. Now, co-hosting with me this evening is Danielle Skipp, Managing Director of Ontario. Danielle.
Thank you. Okay, well, welcome, clients, guests, business associates, and friends. As David has said, it gives us great pleasure to be hosting the Nicola Wealth Strategic Outlook back here in Toronto. The Outlook has always been one of the signature events on our Nicola Wealth calendar. The last Outlook event in Toronto was in 2019, and at that time, I was a guest in the audience, as was my colleague Bijal Patel on the senior leadership team with me, also based in Toronto, and you will be introduced to Bijal later this evening. After 4 years, so much has changed for our company, and specifically for our growth and presence in Toronto. Change is not a unique theme for companies over the past 3 years, through extended periods of working remotely and economic turbulence. Fortunately, change for Nicola Wealth was realized in the form of incredible growth, scaling the firm nationally. In April 2020, when Bijal and I joined Nicola Wealth, we were employees number 7 and 8 in Toronto. Now we are proud to say we have 83 employees here, and our growth continues. Company-wide, our headcount has more than doubled in the past 3 years, with over 460 employees today. This has allowed Nicola Wealth to expand into new markets, such as Victoria and Calgary. We've opened 3 new offices here in the GTA, and we've just upgraded our existing Yorkville offices to accommodate more people. We look forward to opening the doors and welcoming you all there. Investor Economics continues to rank us as the fastest growing private investment counsel firm in Canada. With our added expertise, we have expanded our services to include the integration of Nicola Blackwood Realty Advisors and a renewed and expanded focus on our institutional division. Our institutional team works to extend our investment opportunities to serve the diverse needs of charities, foundations, endowments, Indigenous communities, and family offices. So if any of you are involved with these types of institutions, we hope you'll see tonight's presentation would be reason for those boards to have a conversation with us. We now have the honor of working with over 4,300 individuals, families, and institutions, managing over 13.4 billion AUM. That is a growth of over 90% in a 3-year time frame. With this growth, we have not wavered from our appreciation that our most valuable asset is our people, and that shared success is one of our most important core values. Nicola Wealth is an exciting and rewarding place to work. We bring our energy, our experience, and our expertise every day in service to our clients. I am very excited, as I know all of you are, to hear from our asset management team later this evening. We are going to dig into some of the topics that are arising as we come out of 2022. And let's call it what it was, a terrible year for the broad public markets. Last year, against the backdrop of Russia's invasion of Ukraine, along with rapidly rising inflation and interest rates, most public market indices were down anywhere from -5.75% to -30% or more. This evening, our presenters will touch more on why our Nicola all-weather core portfolio fund was up 7.5% in 2022. But as we look ahead to 2023, the picture seems uncertain for public markets. Why do I say that? Because I see the headlines, just like you, everywhere screaming uncertainty. We are constantly being told or terrified of impending crisis or being preyed upon for that fear of missing out on the next new trend. But this shouldn't be surprising. The media tends to focus on negative news, especially in finance, as it grabs people's attention. Negative, sensationalistic news generates more clicks and more engagement. In the book, The Psychology of Money, author Morgan Housel quotes an historian, "For reasons I have never understood, people like to hear that the world is going to hell." Housel explores the natural human tendency to pay attention to bad news and to react with action, move, get out, sell, hide. How can investors possibly become informed when the world's largest financial institutions cannot agree on what the year ahead will look like? We have Barclays Capital expects 2023 to go down as one of the worst years for the world economy in 40 years. Fidelity also believes a hard landing looks unavoidable. On the other hand, Goldman Sachs, JP Morgan, UBS all expect to see the economy defy the bearish consensus and expect big gains for investors. So what do you pick? Fear or greed? As an investor, do you believe Barclays and Fidelity sell to cash, ride out the storm? Or do you chase Goldman, JP Morgan, and UBS and go long public equities? How can the average investor be expected to reconcile that information? The news creates uncertainty and provokes our natural tendency to do something. Drawing from Housel's book again, we fiddle too much. And this is a good segue. Back to you, David.
Thank you. So fear and greed, those are powerful investor emotions. And as ChatGPT read aloud to all of us in the opening segment, referencing the Dalbar study and the underperformance of investors, in the face of volatility, we are our own worst enemy. And that is why over the past 20 years, we've followed an investment approach that is also practiced by the world's largest and most successful pensions and sovereign wealth funds. It's an approach that sees us take a substantial portion of our asset allocation and steer that away from the volatility of the public markets and instead allocate it towards the ownership of private institutional grade real estate, into the ownership of profitable private businesses, private debt, mortgages, infrastructure, and other private assets. It's an approach that has seen our Nicola all-weather core composite index, which is returns made up of actual client results, outperform a 60-40 public bond and equity benchmark, add alpha of over 3% compounded annually over the past 30 years. Now, because all of us know that true wealth management is more than just investment returns, and in fact, it's our view that everything should in fact start with financial planning. And planning is an ongoing process. As each of us is unique and our lives are dynamic, and as each of us goes through our own personal financial journeys, the financial planning items that you see here on the wheel need to be constantly revisited and reviewed. And lastly, at Nicola, we set a standard for ourselves in going beyond in everything that we do. We work with our clients to achieve their aspirations beyond wealth, and our purpose is to share our expertise and best skills to help you achieve the goals and the legacies that matter. Please allow me to welcome to the stage my partner, our CEO, John Nicola.
Thanks, David. Well, hello, everybody. I was thinking, we just had a presentation similar to this in Vancouver a couple of nights ago. And I was thinking at the time, as we're getting up on stage, that I haven't spoken to a live audience in 3 years. And I'm thinking, wow, I'm feeling, maybe a little nervous. And thinking, is this like riding a bike, or is it more like falling out of a plane without a parachute? And earlier, as I was trying to get ready at home, I'm finding the suit. It actually fits, more or less. And then I'm trying to get my tie on, and I'm just humping and grumping, and it's just not working. Finally, my wife looks around the corner and says, "What are you doing?" She says, "You look like a drunken sailor trying to tie his shoes up." And I said, "Oh, that reminds me why we've been married 48 years. It's because of your positive affirmation." So anyway, let's go through the agenda here that I want to cover in the time I have. So first we want to take a look at things where we see the forest for the trees. We want to take a look at the factors, the macroeconomic factors that will impact portfolios, asset allocation, and rebalancing. How, as a group, can we, our company, add value in the areas of commercial, real estate, fixed income, and public and private equity? And finally, as David alluded to, where does the planning come in? So let's talk about 2023. Is it happy days are here again? Well, there are decent reasons to believe that. The S&P and TSX are both at 4% year to date. That was not the case last year. COVID lockdowns ended in China. The sanctions are starting to make a difference in the Ukraine war. Short-term rates are probably at or near their peak, and inflation has peaked, or at least reasonably we believe so. So there's another way of looking at this from a jobless perspective. Our jobless rate, and 500,000 jobs were created in the U.S. last month, which is a huge number and arguably a record, bringing their unemployment rate down to 3.4%. At the same time, in Canada, we did even better relatively, 150,000 jobs in 1 month, bringing our unemployment rate down from 13% in 2020 to 5.4% today. So these are amazing numbers. Now, the dark side of these numbers are these are exactly the kind of numbers that are going to keep interest rates up or make them go higher, because this is not an economy that looks like it's going into a recession. And until it is, we won't see those rates turn. So let's look at the gloomy side of things. Well, one of my favorite books, or a series of books, is Winnie the Pooh, and my favorite character in Winnie the Pooh is Eeyore. And I know he's obviously the donkey that's always depressed, gray cloud over his head, but he has great sayings, and here's one of them. "If I close my eyes, will this mess disappear?" So we're looking at exactly the same facts, but what does it look like when the glass looks half empty? So first off, equities have gone up, but they've also gone down 4% just in the last 3 weeks. Is this a dead cat bounce? Bull market rallies in bear markets are very, very common. The U.S. and allies are in a serious tech war with China. The Ukraine war could easily last all of 1923, and interest rates remain high for the rest of the year as well. Inflation is coming down, but it's elevated. It's nowhere near the target of 2% the central banks are looking for, and we're in an inverted yield curve, which I'll get to in a minute. So how does that work, an inverted yield curve? You're looking at a graph here that takes a look at all of the recessions since 1980. And before every one of them, interest rates became inverted, which means the following. If you take a look at this graph, this shows the rates difference between 2-year bonds, government bonds, US bonds, and 10-year government bonds. Now, if you think about it, normally, if I want you to lend me money for 10 years versus 2 years, you want more interest because your money's locked up for a longer period of time. And that would normally be the case. That's the normal yield curve. But in this case, the government of the US will pay you 0.8% less per year for 10 years in a row than they will pay you for 2 years. Every time there's been an inverted yield curve in the last 40 years, it's been followed by a recession. And that's the expectation of Morgan Stanley, who would expect that to occur sometime this year. So let's take a look at the forest for the trees. These are some macro issues that I think will dramatically impact people's portfolio and asset allocation mix, not necessarily just this year, but over the next 3 to 5 years. So we're going to take a look at aging, the supply chain issues, interest rates, reshoring, and climate change. So let's take them one by one. If we take a look at aging, for example, if you take the 50% of the countries in the world with 50% of the population and 70% of GDP, that group of countries, all of them have negative birth rates. Is a negative birth rate inflationary or deflationary? Because that's a real interesting issue as it relates to interest rates. And what's the impact on capital markets? With interest rates, we've had a 40-year bull market. Interest rates are basically declining almost in a straight line from the high interest rates of 1981-82, where they were peaking at around 21% on prime, and now went to 0. That bull market in bonds is over, and it's very hard to imagine anything like that being repeated again in our lifetimes. We are now at the highest interest rates we've had since 2007. It's very much inflation dependent, and the question is where to from here. When we look at supply chain issues, it's very geopolitical. So essentially, the Ukraine war had a big impact on food and energy prices. China conflict with the US, COVID strategy, real estate bubble, and demographics are all big issues from a Chinese perspective, keeping in mind the Chinese are the world's largest exporting nation. And then the question of reliability of shipping and transportation and manufacturing. One of the things, there's a great book by a guy named Peter Zeihan called The End of the World is Beginning. And it was written 2 years ago, so he was well ahead of his time in saying, we're seeing the end of deglobalization. Global trade is going to peak and then flatten and then start to decline over a period of time as more and more countries basically make a decision they're not going to be doing exports and imports at the levels they were before. And that is a material issue because from World War II up until roughly about a year ago, the US Navy guaranteed that any country shipping to any other country would be able to do so free of any risk of interference from a military perspective. And they have stopped doing that. So those guarantees are no longer there. In terms of reshoring, which brings us to the point of why companies are coming back to the US, they want to bring supply closer to demand. They want to reduce the shipping cost, the safety of technology, I should say, and the rule of law. And there's wage differentials as well, with Mexico, Central and South America, possible winners, maybe to some degree Canada as well. And the other thing to remember is that the Western Hemisphere has over 1 billion people. It is a significant market in its own right without having to export in any big way from a shipping perspective. And then climate change is driven obviously by climate and technology. Challenges will be basically with solar and wind and battery storage. Nuclear is in play, and maybe eventually over the next 5 or 10 years, fusion as well. Canada can be a winner from a global perspective because of warming. And fossil fuels will decline, but they will persist. So they'll still be part of the equation. The other things that we need to look at, geopolitics, inflation, and recession. How do these things combine? All of these things combine to determine the kind of portfolio rebalancing that you should be experiencing. So let's look at one of them, demographics. We talked about, is aging inflationary? The theory sounds logical. People get older. Basically, they're going to need to spend more money on health care and other things like that. And on theory, that sounds great. In practice, this is how it works. The biggest spending cohort is between 46 and 50 family college kids. If you want to get an idea of the impact of aging in terms of inflation, take a look at what's happened in Japan and Germany. And that will give you some indicator of what we should expect here, because they have the lowest inflation of major developed countries in the world. And that's likely to continue. China's likely to be following this very soon. So when we talk about China, last year they lost 800,000 people. In theory, the first time in their census in the last 60 years, I think, since the Great Famine, that they had had a declining population. Now, some people argue they haven't been keeping the numbers correct, and this has actually been going on for a while. What has also been happening for sure is this, that even though the population may have turned this year, the working age population peaked in 2012, 10 years ago, and 18 million people are no longer in the workforce between the ages of 15 and 64 in China compared to just 10 years ago. And you can see it's just going to continue to decline. It's basically irreversible at this point in time. The birth rate in China has dropped to 1.16, which is basically half the replacement rate required for a population. And because the number of people that are actually between the ages of, let's say, 15 and let's say 40 who could have children has already shrunk, there's no way that that can change. You can't create a birth rate that's going to basically get to replacement in China. And then the other thing that the Chinese Communist Party has done is decided that its objective of growth has to be done by two things, exports and infrastructure, not at the expense of the consumer. So Chinese consumers have a lot less money to spend of the income they get than almost any other major countries in the world. And here's an example of that. We're looking at 7 countries here. There's the percentage of the national economy that Chinese citizens get to spend. It's about 50%. Some say it's around 40%. And this is a choice, this is a political decision to do this. They would have to be at least where India, Japan, or Germany is to be able to be a consumer power. And that would cause the Chinese economy to grow much better than it's growing. But it would also give more power to the individual citizens of China, and that's something the CCP does not want to see happen. So it's not happening. The other thing is that labor costs are dropping in many other countries as well. These are the labor costs going back to 2020. They've been lower than China since before 2016. So if you can imagine a US company deciding that they're going to remove plants and manufacturing from China and they're going to move them to Mexico, well, the first thing is their labor costs are going to be lower and their transportation costs are going to be a lot lower. And then finally, one of the issues about China is you would think a country for the last 30 years that's grown at probably an average rate of 7 to 9% a year, so that's a very fast-growing economy, would also be a great place to invest. I mean, that's a very impressive growth rate. This is the rate of return of the MSCI index in China for the last 30 years, 1.2% a year, against the S&P 500 at 9.7% a year. So these two things haven't correlated. Investing in the Chinese equity markets has not actually been something that's generated great returns at all. Let's take a look at interest rates. The rates are going to may continue to rise, more likely in the States than in Canada. There's going to be a negative impact on all asset classes. You know, it's pretty hard to prevent that because what's happening is you're getting a really decent risk-free rate of return, so it's making other asset classes look weak. How far before the bear market in bonds ends? Well, it's not ended yet. So even though interest rates had been declining, they've been going up for the last 6 or 7 weeks. So bond prices have dropped 6% in the last 3 or 4 weeks alone in the US and Canada. And in addition, you know what the impact has been on housing. Both in, for example, in Toronto and Vancouver, you have significant drops in housing prices and housing sales. Basically, the price is likely to drop by at least 15% by mid-2023 with one saving grace for Canada, and that is that we have a significant influx of immigrants already coming in, rising, and that will create a demand for at least 500,000 new homes in Canada in the next 3 years. And that may be the biggest saving grace to what happens in the housing market in terms of pricing. In the meantime, the US housing prices have dropped 12% to November of last year, likely to continue to drop as they dropped 12% in Canada. So these drops are likely to continue. I would think the Canadian drop in the big cities, especially Toronto and Vancouver, could easily get to 20% plus by the time, from peak to drop by the time it's done. A recession coming, everybody seems to think there is one. And if there is, it is an interesting way to deal with inflation because it will work. It will absolutely reduce inflation. It will stop all of the rate hikes from an interest perspective, and it might finally be an opportunity to buy and get in a bigger way, both in terms of equities and in terms of bonds. Let's look at geopolitics. We have the Russian-Ukraine war, of course. It's had a huge impact on commodity inflation. Russia now obviously is a pariah state. It's a nuclear threat still. It's demographically imploding. I don't know if you appreciate exactly how fast the population is declining. And that's not including the people who just voluntarily choose to leave. Oil and gas revenues are down $150 million US per day over the last 12 months. And their deficit last year was $47 billion. And the deficit for January, the month of January, was at $25 billion. Now that may not sound like a lot, but you have to appreciate Russia is 10% smaller economy than Canada. So you just imagine those numbers applying to us, and now you appreciate exactly how bad the situation is financially in Russia. If you look at China, there's this new trade war in tech, the world's largest housing bubble, debt issuance and default. The level of Chinese debt at the government level has been exploding for years. Much lower future economic growth. That's demographics, that's debt, that's that kind of mercantilist economic model that they have. The rule of law, not really available there. And in our opinion, that makes China uninvestable until such time as you see something different from a government perspective. From a climate perspective, I mentioned that Canada might benefit from climate change, and with global warming, it has a very good chance, as would Russia, for example. One other thing about climate change is that usually oil companies are considered pariahs. However, this is a graph saying that BP is one of the top renewable energy performers in the oil and gas sector. In other words, creating, effectively having a bigger impact on reduction of carbon than most other corporations around the world. On the other hand, there are other oil companies which are much, much worse off. So the devil's in the details when you take a look at how you'd want to build an ESG portfolio. Some companies that would surprise you should be in the mix. So we talk about it, this is on our website, Beyond Stocks and Bonds, and we talk about this issue. The whole is greater than the sum of the parts. So the whole is the actual portfolio. That's the strategy, that's the asset allocation mix. The parts are tactical. In other words, you've got private capital, you've got public capital, and you've got real estate. The issue is we have to execute as a firm well in each of those tactics in order for the whole to work well. So let's use an example. Some of you may know our real estate has done very well over the last, 15, 20 years actually. And I thought I'd do an analysis taking real estate out of the equation. And what I wanted to take a look at is what we call the 60-40 portfolio, 60% fixed income, 60% equities, 40% fixed income. And this is a graph that you can't possibly read, but it's the performance of an average of Canadian neutral balanced managers, about 240 of them, in basically 60-40 portfolios. I wanted to compare it to what people would have earned with us in private assets, using 60% private equity in lieu of public equity, 20% in mortgages, and 20% in private debt as fixed income. And the results are quite interesting. In the public returns, for the last 5 years, the outcome is around 3.9% a year return. For private, it's 10.01% return. So in other words, the gap is just huge. So in other words, you can get, private assets can give you great risk-adjusted returns. There is a price to pay from a liquidity perspective, but in terms of a return perspective, it can be a really great positive. In terms of public equities, one of the things we tend to look at is we want each part of our performance to do well, to be tactically superior. We have about 11 funds, 7 equity, 3 fixed income, and 1 balanced fund. We compared them again to the Morningstar database for each peer group. And we looked at year-to-date 2022. This was done later in the year, so this is to September, 3 years and 5-year periods of time. That means there were 32 possible data points. And out of 32 data points, our public equity performance and fixed income performance was 31 data points hit Q1 or Q2 performance, which is considered extraordinarily exceptional, and 25 of the data points were in the first quartile. So again, it's important to be able to make sure that each one of our 3 components is performing tactically really well. And then when we combine them, we're going to get the results we want. On the real estate side, Mark is going to talk a lot more about this in detail. This is just our original real estate fund. It was created in 2005. And it's got a long 17-year track record. This is comparing it to the TSX REIT index So if we had never created private real estate, we could have just made a decision. We're going to go and buy REITs for clients, and that'll be their real estate portfolio. That's what actually most firms do. We made a decision it would be better to own the real estate, and thanks to Mark and his team, which he's going to explain in much more detail in a minute, the results have been pretty extraordinary. Over the last 17 years, the difference in return is 3.1% a year higher return per year, even though we're buying real estate in the same country. And the difference in volatility is 82% less volatility than with REITs. Going on to this interesting article. I really like this guy, Howard Marks. He wrote a really good memo no more than a month ago called Sea Change. If you want to get a copy of it, let us know. We'd be happy to forward it on to you. It's really brilliantly written. But basically he's saying in his 52-year time frame in terms of investing, there have been 3 secular changes. The first was the rise of interest rates and inflation all the way from post-World War II all the way through to the late 70s, early 80s, and that just decimated returns on bonds. And then, when interest rates got to 18% on 10-year bonds, from that point forward, for the next 40 years, bonds were a killer return because they went from an 18% yield virtually to zero over a 40-year period of time. So that was the second secular change. And the third one, the sea change he's talking about now, that's the one that's occurring as we speak. And the things I talked about earlier here are the kind of factors that are occurring in this sea change. So we're not going back to 0% interest rates, and a lot of other factors are likely not to change as well, including long-term inflation. We did write a newsletter about 3 years ago on this issue, and these are some of the top managers in the world: BlackRock, Vanguard, Morningstar, and they wrote about future returns, and their expectation for future returns on a balanced portfolio back then, 3 years ago, was 1.36%. Well, how's it been since then? Well, the return has been around 1.9%, so pretty close, but that's before inflation and fees. If I take the inflation and fees out, it's minus 3 to 4% a year. So in other words, this prediction that was put together 3 years ago is actually completely on track for expected returns over what is now the next 7 years. So where do we add value? In industrial real estate, in real estate and industrial and residential, the repositioning of assets, special situations, and of course, build to own. We think build to own is actually one of the major keys to future returns. Private assets and mortgages and private debt on the fixed income side, separately managed accounts, and floating rate debt. So that has worked quite well for us already. And directly managed assets and value cash flow approach on the public and private side of equity is where we think we can add value there. I want to just leave you with this in terms of we haven't had time to spend time on planning, and we're going to probably try to do this separately in some podcasts because this needs a more detailed look. But planning matters. So we have built a number of advanced planning tools. These are just 3 of them. One of them is a compensation analysis that can determine whether you should be taking dividends or salary as compensation, the impact of having an active business rates, when both salary and dividends make sense, and when to use what are called IPPs versus RSPs for retirement savings. For estate planning and philanthropy, taking a look at how much tax you're paying on your income and where that impacts asset building, the timing and structure of philanthropic gifts, the projections as to estate growth and foundations using donor-advised funds, and the tax liabilities in the estate and how you can mitigate them. In some cases, actually bring them down to zero. And then finally, the tax analysis on an investment. So what's the tax efficiency of your non-registered investments? What's the difference between corporate and personal investing? And how would you use insurance, debt restructuring, and philanthropy to reduce taxable income? So there's a lot packed in there, but the fact is we'll get into that through a separate podcast for those of you who would like to drill down a little deeper in that area. So with that, I need to pass this over to my colleague Ben, who will talk about public assets in more detail. Ben.
Thanks, John. So, how were the markets last year? In one word, terrible. For a 60-40 portfolio, for a 60-40 benchmark, it was the 4th worst year since 1926. fourth worst in almost 100 years. Now, I'm talking about the market here, not our funds. As John mentioned, our strong track record in our own funds. But nevertheless, challenging environment. If we take a look over the past 20 years for a 60-40 portfolio, we can see that the returns have been reasonably good. Again, last year, terrible. Second only in recent memory to the great financial crisis. In 2020, there was $18 trillion of negative yielding debt. Trillion dollars. That means in Europe, if you bought a GIC, the bank didn't pay you interest, you paid the bank interest. You guaranteed yourself a loss. And there was $18 trillion that were in guaranteed loss positions. Today, there's effectively zero. There has been a massive change. This evening, I'm going to review with you in more detail what happened in the public markets last year, what we expect going forward, and most importantly, how are we positioned? How are we positioned to protect your capital? How are we positioned to enhance returns? Last year, it was all about inflation. You see, we started the year at 7% inflation. And despite central banks aggressively raising interest rates, we finished the year at about 7%. The target for central banks? 2. This year, it's about a game of chicken. The market is playing a game of chicken with the Fed. The market believes and is priced in for the central banks to aggressively cut interest rates by the end of this year, whereas the Fed said that they won't. Who's going to swerve? Who swerves first is crucial for investment outcomes going forward. So, why does the market believe that the central banks are going to cut rates aggressively? Well, this is Jerome Powell, the head of the US Federal Reserve. They've lost confidence in the Fed. When inflation was rising, Jerome Powell said, it's all transitory. Don't worry about it. And yet inflation rose higher. He said, everything's fine. It's working the way we expect it to. Yet inflation continued to move higher. And he said, inflation is coming in higher than expected. So he started to get a little concerned. And finally, we're not expecting near-term progress on inflation. So they went from, it's all transitory, don't worry about it, to inflation being on a rocket ship and basically saying, Houston, we have a problem. Now, we think that central banks are likely to keep interest rates higher for longer. If we take a look at the 1970s, we saw twin peaks of inflation. If we track that to today, yes, we have seen inflation start to roll over. But in the 70s, it took 2 years for inflation to normalize. And even after that, inflation spiked up again. Now, we're not saying that we think that inflation is going to spike up. But we are saying that it's weighing in the back of the mind of the central bank. They're concerned about it. And so likely, they'll err on the side of caution and keep rates higher for longer. What does this mean for your investments? If we take a look at fixed income yields when interest rates were effectively zero, investment grade bonds were paying you 2%, and high yield bonds were paying you 4%, and press were paying you 5%. The yield on high yield bonds, it actually wasn't that high. Now, with interest rates considerably higher, investment grade bonds are paying you 5%. High yield bonds are paying you 8 to 9%, and preferred shares are paying you 6%. That's the good news story. Fixed income yields are attractive. Where specifically do we see value in fixed income? If we take a look at the yield curve, as John mentioned, it's inverted. That means 20-year bonds, the yield on them is actually lower than 2-year bonds. We're focused on shorter duration fixed income. We're focused on good credit quality names. We're focused on a space that's generally lower risk, lower volatility, and the yield is higher. Now, what about equities? We think earnings are likely to come lower. and potentially we might see a recession. But we don't think we're going to see a large correction in the equity markets. It's all about cash. You see, corporate balance sheets are quite strong. Debt has been termed out and extended. 60% of institutional allocators are underweight equities and overweight fixed income and cash. Investors are defensively positioned. Generally speaking, when we see a large correction in the market, it's due to crowding. You see everyone is positioned in one way. There's a rush to the exits and the stampede, and that's what causes a lot of pain. We are not in an environment where we see a lot of crowding in equity markets. Where do we see opportunities then in equities? We like value versus growth. Growth being high-flying technology names, value being companies at good valuations. In the late 90s, we were in a situation where we had mega cap names take leadership in the market. These were names that benefited, they were high growth names, and they did extremely well for a number of years. The market then rolled over, and we experienced a period of time where value outperformed growth for a number of years. We are seeing a similar situation today. More specifically, when we take a look at value, we like high quality names, the intersection between high quality and value. Quality meaning companies with good balance sheets, high free cash flow. Generally speaking, these are companies that are dividend payers and dividend growers. So yes, we think that earnings are likely to come down, and we'll likely see more volatility in the marketplace, as measured by the VIX. When we take a look at market returns during periods of above average volatility or rising volatility, we can see that market returns are a bit more muted. When we compare that to dividend payers and dividend growers, the returns are significantly higher. So we like dividend payers, we like dividend growers, we like high quality names at good valuations. We also like real estate. REITs are trading at a 20% discount to NAV. Industrial REITs are trading at a 10 to 15% discount, a place that we really like. You see, the volatility has created opportunities for us to buy attractive assets on sale. Now, when we compare international equities versus the US, we can see that valuations in the US market have started to roll over. But when we compare that to the international market, we can see that valuations between the two still remains in favor of international equities. So we like international equities. More specifically, we like European equities. If we take a look at the market, all 11 GIC sectors of the US market, and look at their valuations. Farther away from the center is more expensive, closer to the center is cheaper. When we compare that to the European market, every single one of the 11 GIC sectors in Europe is cheaper than the US market. So, bonds are back. We are seeing attractive yields in fixed income that we haven't seen for quite some time. We're seeing the high yield market pay us 8 to 9%. We still believe it's prudent to remain diversified. We are defensively positioned in our equity portfolios. And that allows us to turn volatility into opportunity. It allows us to buy REITs when they go on sale. We are focused on the intersection between quality names at good valuations, dividend payers and dividend growers. There are a lot of tools in our toolkit to protect your capital, enhance returns, and find alpha. Thank you. My colleague Bijal will speak next.
Thank you, Ben. It's my pleasure to be here today and talk to you about private capital and our outlook for 2023. To begin with, though, let's take a look at 2022 and some of the key events that occurred. We had the ongoing war in Ukraine. We had customers and consumers dealing with inflation on a day-to-day basis. We had billionaires being, well, billionaires. We had the ongoing impact of climate change around the world, but stock market volatility, and who can forget the slap? So with all of that noise in the environment, how is one to think about when investing in private capital? It reminds me of a pair of scissors. The first time I held a pair of scissors, my parents told me, scissors are a great tool, but you need to be thoughtful about how you use it. Investing in private capital is the same way. Private capital is a great investment tool for every portfolio, but you need to be thoughtful about how you allocate money into it. And if you want to be thoughtful and find alpha in this space, you need to remember three things. Pick great partners, number one. Partners who have long-term track records. Number two, lean in on active management. Find companies where value creation exists. And number three, portfolio construction. Diversification is your friend here. No big bets on any single names. So with that, alternatives are becoming an increasing part of the investing landscape. Back in 2005, they accounted for about 10% of the total picture. Fast forward to now, it's about 17%. That's an increase in mix of 70%. And if you look at the forecast, that trend is expected to continue, up to 19% by 2026, with AUM growing in this category by 9% a year. So why all this demand? Why are investors flocking to the space called private capital? Well, as you can imagine, it always starts with returns. If you look across three big buckets of equity, credit, and infrastructure, the blue bars are the private market returns, and the green bars are the public market equivalents. And with these enhanced returns also comes historically less volatility, less movement in prices on a month-to-month or quarter-to-quarter basis, so steadier ride. And now we have newfound demand from the emergence of retail investors. David mentioned before that institutional investors have been investing in private assets for a long time, some up to 30 to 50% of their allocation. Retail investors, maybe 1 or 2%. But now with the emergence of product innovation and greater awareness about the return profile and volatility profile of private capital, retail investors are creating newfound demand. So why invest in private equity? Let's go through some of these portfolios. Well, the first reason is access to more companies. Only 1% of companies in the United States are listed on a public exchange. Even if you take bigger companies, so companies with 500 or more employees, only 15% are on a listed exchange. So think about that for a minute. If you want access to more diversification, great companies, you need to lean in on that 85% that are only available in private markets. Active value-adding ownership. Private equity historically has shown the ability to go in, buy companies at a lower multiple than the average company on the index. And once they acquire them, they've been able to demonstrate faster revenue growth and higher profit growth than the average company on the index, which of course has led to higher risk-adjusted returns. So what are some of the themes in private equity for 2023? Well, the number one is valuations will be under pressure. The days of hot stock markets, easy credit are gone for a while. And valuations are going to be driven more by earnings profile and earnings growth for each of the companies. The good news is, in these types of periods where valuations come under pressure, it's often a great buying environment. So if you look back historically at some of the more difficult periods, Gulf War, dot-com bubble, global financial crisis, and COVID, you can see the private equity returns during those periods, both on an absolute and relative basis, performed very strong. So now let's turn to infrastructure. You've got transportation, energy, data farms, social infrastructure. What do all of these industries have in common? They're essential services, for one. They're needed on a day-to-day basis. They often have contracts that adjust with inflation. They're safe counterparties like governments, and low competition due to high barriers to entry. So investors in infrastructure have been benefiting from inflation protection, predictable cash flows, and low volatility. Now, I know most of you think 2023 is the year of the rabbit. Some of you may think it's the year of the balloon. I'm here to tell you that no, it's actually the year for infrastructure. In no other environment than this one, where you've got low growth expected for the next couple of years, high inflation expected for this year, this is the exact moment when infrastructure shines relative to all other asset classes, including real estate, equities, and fixed income. In addition to that, there's great demand coming from massive commitments around the world that nations and governments have been making on energy security and carbon reduction. Over $4 trillion a year in new infrastructure spending has to occur to meet these commitments. And then, of course, there's digitization, the movement of information. I know this one's really important because I've got 2 daughters, and the only way they communicate to me is by text, even if we're in the same room, sitting right beside each other. There's only one event that'll make them call me, and the conversation usually sounds something like this. Hello, Dad. Yes? Wi-Fi down, fix it now. When information gets interrupted for consumers and they can't do that next TikTok video, or businesses and they can't upload into the cloud or access information in the cloud, chaos happens. And that's why there'll be continued spend in data infrastructure and digitization. So let's turn to the credit side of the equation with private debt and mortgages. Why have investors been flocking into these asset categories? Historically stable income. A lot of these instruments are written as floating rate loans, so even if interest rates go up, the coupon goes up as well. Downside protection. You can see on the left-hand side the stacked bar of a typical capital stack of a company. If a company gets into trouble, the first people to get paid are the secured debt holders of the mortgages and the senior debt holders, private debt, and lower volatility. So some of the themes for private debt and mortgages, there's no other asset class that's benefited more from rising rates than these 2 asset classes. Yields are going to be strong. If I was standing here a year ago, I would have told you interest rates look like they'll be 6 to 7% in this category. Now we're seeing 10 to 12%. In addition to that, banks are doing what they often do in these types of markets. They're pulling back, ceding share to private lenders. Covenants are also getting stronger. Leverage is getting lower. So if you look at this picture, this is like Disney World for these guys in private lending. You've got better pricing, less competition, and lower risk. It's a great time. You're getting public-like return, you're getting equity-like returns with holding debt. Now, of course, the danger is it's debt. So what happens with defaults? Right now, they're low and muted, but the final story on defaults won't really be told until we see what type of economic landing we have, whether it's hard or soft. So now I'll talk a little bit about Nicola and what makes us different in thinking about private capital. Remember the scissors. You want to be thoughtful about how you invest in private capital, and to be thoughtful, you need to pick great partners and have great diversification. So our first advantage is scale. We've got one of the largest private capital platforms in Canada, $3 billion across all the asset categories that you would like: equity, venture, debt, mortgages, infrastructure. We've also got a team of 20 and growing that look at this portfolio on a day-to-day basis and manage it for our clients. The second big advantage is products. We break down traditional barriers to private capital. It's a great bumper sticker, but what does it mean for you? It means typically if you wanted to invest in this asset class, you'd have to come forward with a large dollar deposit, maybe $1 million, maybe more. You couldn't ask for the money back for 10 years, maybe longer, and you get a limited set of diversification. With Nicola, it's a low minimum to entry point for each of our investment pools. You have the ongoing liquidity rights and redemption rights. And across our pools, you get great diversification. So what's the bottom line? Number one, always focus on long-term value. Yes, there's going to be pressure on equity valuations, but also history's shown a great buying opportunity. Rising rates have been helping fixed income the most. And infrastructure truly does have the wind at its back. And with that, I'd like to turn it over to Mark, who will give us an update on real estate.
Thank you.
By the way, nice shoes, Mark.
You like that? It's comfortable. Thank you, Bijal. This is the last round of speed dating. So my name is Mark Hanna. I'm the Managing Director of Nicola Wealth Real Estate. On the screen is, we just completed a webcast a couple weeks ago, and John Nicola did 20 minutes on a good economic overview, similar to tonight. And then the latter part of the presentation was a conversation with Mark Renzoni, who's on our investment committee,
along with my colleague Alex Messina and myself. And we do this every 6 months, and it gives a full detailed review of our real estate portfolio. I understand that webcast, after they did all the edits, will be released, I think, tomorrow. So if you're a client, you will receive an email. If not, it'll be on our website that you can access. So unfortunately, I don't have an hour to go through today. I have a much shorter time. So I've chosen to talk about 3 topics today. I'm going to talk about our returns for the 3 real estate LPs. I'm going to talk about what's happened in the last 5 years. What have we changed in terms of our strategy in asset class and geography? And then the third will be in keeping with the Finding Alpha. It'll be what are we doing going forward? What are the investment themes that our group is looking after? Just a bit of background on our funds first. We are, the real estate, when you include the Blackwood team, is $9.6 billion in gross assets under management. We have 324 properties. We have 19 million square feet. And last year we did $1 billion in acquisitions. So you can see on the left, there's some selected acquisitions on the left, and on the right, the projects we have under construction, and then underneath are some selected properties that were leased. Last year, in 2021, it was a very strong year. We did $1 billion in transactions. That was the second best year. The year before, we did $2 billion. And the reason that it was less is there's no question with the rise of interest rates, we decided to go a little bit more cautious approach, and we slowed down with acquisitions. But we still managed to close 50 transactions. Our team did 230 lease deals, totaling 1.8 million square feet. And we have over 4 million of square feet under construction with our development team, comprised of over 20 projects. And then finally, we have 1,106 storage lockers under construction, and I'll talk about that in a moment. So now the 3 real estate funds, starting with the Canadian Real Estate LP. Now, this was the first one that started in 2006. You can see the average return since inception is 9.8%. The return last year in 2022 was 13.2%. So if you look at the outliers, the underperformers were 2008, which is the mortgage debacle, and 2020 with COVID, so understandable. The outlier on the overperformance was 2021, and the reason for that is we have, for a number of years, been investing heavily in the Toronto market, and Toronto is our biggest position in any city in North America, and it's mostly due to industrial, with a great help with some partners and with the benefit of property increases in the valuation and income growth. Moving to the US fund, this fund was established partway through 2010. The average return since inception is 11.8%, and last year a record year of 22.7%. So why did that happen? It's primarily due to 2 reasons. One, which was the main reason, was our very large multifamily portfolio, which you're going to see in a moment, which is over 50% of that portfolio with a significant income growth, and with our industrial portfolio that's now growing in that market. And finally, our value add fund, which is a merchant fund. This was established in 2014 or 2015. The average return since inception is 14.6%, and the return last year was 19.6%. So what the takeaway from this is that all 3 funds have been very consistent and resilient since inception. So now let's just talk about what has happened over the last 5 years. How have we changed our strategy? As I say, we keep getting smarter all the time. So looking at the Canadian fund in terms of asset classes, you can see that we've gone up in industrial, and that's largely to do with Vancouver and Toronto, especially in Toronto. Development, 5 years ago, we only had 5%. Now we're at 17% and growing. That's because we can get better returns on build to own. Office, we were 25%. We've all read in the paper about the office market and people not coming back to work, so we have purposely lowered that allocation to 11%. There are certain types of office that we still like, and I'll reference that in the next section. Self-storage, we love that group. It's was 11, it's at 12. It actually has gone up. It's just that the fund has grown so much over the 5 years, and we've added to the portfolio. Multifamily, 5 years ago we were 0, and now we're 10. And when you look at the projects that are in the development graph, some of those projects, when they're completed, are residential projects, and they'll add to that category. So that will go up to around 20-25%. Seniors housing, it's actually performed very well for us. It was 95% before COVID, went down to 85, now it's back up to 95, so it's done very well. We like that category. We might add more, but we're just taking a cautious approach with that asset class. And finally, retail. We're not a big retail buyer, and so that's gone down. In terms of geography, obviously Vancouver is our home base, and that continues to be a strong market for us. In particular, we like Vancouver, but also Kelowna, Victoria, and Nanaimo. Ontario, lots has changed in the last few years. It's now 31%, and I can see that going up higher to 40 or even 50%. Alberta, a lot of people were concerned that we had too much in Alberta 5 years ago because of oil and gas. That has gone down, partly because we've sold properties, and the funds just got bigger. Moving to the US fund, multifamily. Again, that was one of the biggest reasons why we had such a great return last year. That was 58, and it's now 52. It's not that we sold assets, it's just that the fund got bigger. I envision that category still staying in that 50% range going forward. Industrial, that was a big decision we made to go forward, is let's build up that industrial base. It's worked well for us in Canada. We're doing it in the US, in markets like Phoenix, Vegas, Dallas, Denver, Seattle, and Minneapolis. Office, again, similar theme to Canada. We're downgrading the allocation from 27 to 15. Development build to own, not growing as fast as in Canada, but we are planning to move that up to the 15 to 20% range. And finally, retail, similar to Canada, it's not a category we're pursuing. And finally, geography for the US. Texas is a big market for us, as is Seattle, which is Washington, Georgia. It's not that we're selling assets, it's just that we've added in the other markets, Florida, Minneapolis, Nevada, Arizona. So they've only come down because those other states, we've invested in those right-to-work, tax-friendly states. Our team. I am doing my favorite job. I've got my dream job working with this team. And they are passionate and a dedicated group of 65 people. They care, they work hard, and they're committed to getting great outcomes for our clients. And with this, we have a very specialized group. As you can see, asset management, development, financing, insurance, leasing, legal, mortgages, and investments. We laugh, we have a lot of fun, and they care. Also, we have partners, and some are here tonight. And we couldn't grow without our partners. And the partners, and hopefully I don't forget the names for out east here, but it's First Gulf, Great Gulf, Venterra, Northbridge, Hopewell, and Claria. All of those partners are important to us, and they've contributed to our growth. Okay, now moving on to the last section, the investment themes, finding alpha. In no particular order, starting with multifamily. The multifamily has been good to us. So in Canada, it's very difficult for us to buy existing apartment buildings at numbers that work. So we are building. In this case, it was a renovation. So we're building new product because we can get the better returns. We cannot buy the product and make them accretive to our funds. However, in the US, we're able to buy existing with our partner at numbers that do work, and we're able to get that income growth. So totally different strategies for each country. Industrial. There's 3 types of industrial that we like. There is the mid-bay, there is the IOS sites, and then there's the small bay. Starting with the mid-bay, and mid-bay might sound small, but in this case, a partner helped us build this property in Mississauga. It's 300,000 feet, and it was completed in 2021. We had 4 offers from full building users. We ended up doing a deal with Amazon for 10 years. And the reason I like this building is even if Amazon left after 10 years, it's got so much utility and a great location, we will never have a problem leasing out this building. Here's another one in Toronto, right on the 401 and 601 Milner in Scarborough. The building looks like it's finished. It's not. It's a pretty good rendering, but we are starting construction on this building now for 350,000 feet. We know that this is going to command a lot of interest, and it's got great exposure to the major highway. Build to own, this is another one. This is in Vegas. I was just down in Phoenix and Vegas. This building just got finished by Hopewell. We have 3 offers for the building. We designed it so that we can multi-tenant it, but we actually have one group that wants to lease the entire building, a logistics user. IOS. What's IOS? It's an industrial outside storage. And this is my favorite property in Las Vegas, Adona Street. And typically they're 9 to 10 acres. The properties are fenced, paved. In this case, it has a wash bay, little building, and then they can park their vehicles and any materials. Why do I like this? Because this is a future built-in inventory for us if we ever want to build. So if you look in the bottom left, we've already designed what we could build one day. But in the meantime, all these users are getting squeezed and they have nowhere to go in an infill location. So we like these locations, and this could continue on for many years. And we're doing this in Dallas, Phoenix, Vegas, Denver, Seattle, all those markets that I mentioned. And finally, small bay in the industrial category. This one's in Ontario and Oakville on Wycroft. We acquired this a year ago. They were smaller tenants. We're all on short-term leases. Our team has already rolled over 90% of the tenants, and the net income's almost doubled. I've thrown in this in here because this is in our value add fund. This is a very popular product, and it's small bay strata, or here you would call it condo. They're typically 3,000 square feet. We've done about 18 of these in Vancouver, and it's typically an owner user, the pool guy, the concrete guy, construction. They want to have their own real estate, and you can see on the bottom right the dollhouse design or 3D design. You've got your showroom in the front and the office upstairs and the warehouse in the back. We now are doing this in the Toronto market with Northbridge and with First Golf. So we're bringing that strategy to the Toronto market. Self-storage, one of my favorite categories. We now have 9 and growing. This is a picture of our one in Squamish. We bought this a couple years ago. It had an existing building. It had 880 lockers. It had a site next to it to build a sister building. You can see it's just getting tilted up. That's a very recent picture. When it's all done, we'll have 1,700 lockers. Why do I like self-storage? Where else can you have people pay $500 a month to store $300 worth of junk? And then when they leave, you roll up the door and you sweep it out, and you don't pay commissions, and it's a great business. Sadly, I have a couple lockers myself, so I'm one of those people that are. But we love this business. I'd like to get this up to 25 in the next couple of years, and we're doing our first one at Royal Windsor and Winston Churchill, right in the corner, and hopefully we're going to start construction on that very shortly. I'd like to see us do a lot more here in this market because it's growing so fast, so we need to meet the needs of the residential growth. Covered land play. This property we bought a year ago. It's in Seattle, and as you're going down the I-5 towards downtown Seattle, it's on the left-hand side. Seattle just put in, believe it or not, they just put in a transit system. And we're right across from the transit station that takes you right to SeaTac Airport, and on it is 3 office buildings. And what's happening is our team is getting far better income growth on this property than we thought. But the reason we bought it is not because it had office. It's because if you look in the bottom left, we can build 2 million feet of residential space right across from the transit station. So that's what we call covered land play versus dirt. Last slide. Creative office. So we don't like office towers generally, but we do like either single-story office, flex office, or in this case, what I call creative office, 3 to 4 stories. We have a number of these in Vancouver, especially in Mount Pleasant. This is one that's just finishing. It's 4 stories. There's still strong demand from these users for this kind of space. So we like this product, and we're going to continue with this asset class. So that completes my presentation. Thank you for your attention. I'm going to invite David Sung back up.
Thank you, Mark, and thank you, John, Bijal, and Ben, for each sharing your insightful perspectives this evening. So this concludes our formal remarks and presentation for this evening. So here's what the plan is going to be. We are going to do a Q&A, and we're going to have our speakers come back up. We're going to take a 5-minute break for that. So those of you that want to participate in the Q&A, you can stretch your legs and maybe grab a drink and come back in 5 minutes. And for everybody else, the bar and the hors d'oeuvres are open, and thank you everyone for joining us tonight.